The monetary model. The monetary model states that the value of a currency is dependent on money supply, income levels, interest rates, and inflation rates. The model tells us the domestic currency will depreciate when there is an increase in the money supply, a decrease in income, or an increase in the level of inflation. Conversely, the domestic currency will appreciate when there is a decrease in the money supply, an increase in income, or a decrease in the level of inflation. Followers of this model, therefore, see the growth of a nation's money supply in relation with inflation and inflation expectations. They sustain that, for the most part, a currency increases in value if there is a stable monetary policy, and that a currency decreases in value if the monetary policy is erratic or unstable. The monetary model assumes the purchasing power parity to be true. In other words, if domestic prices rise, meaning inflation goes up, the currency will fall in value as money flows out of the country into countries with cheaper prices. If domestic prices fall, the currency will rise in value as more money flows into the country from countries with higher prices. The model also tells us that there is a proportional relationship between the money supply and the exchange rate, meaning that a 10-cent rise in the money supply leads to a 10-cent rise in the exchange rate. The monetary model is a hybrid of the quantity theory of money and the purchasing power parity, both of which follow the property of proportionality. The quantity theory of money states that an increase in the money supply leads to a proportional increase in the price level. The purchasing power parity tells us that an increase in the price level leads to a proportional increase in the exchange rate. Let's break that down piece by piece. If the money supply goes up, the country will experience inflation. In other words, prices will go up. The currency will get weaker following the purchasing power parity as money flows out of the country seeking cheaper prices elsewhere. If the money supply goes down, prices will go down, and the currency will get stronger following the purchase power parity as more money flows into the country from countries with higher prices. If the income level rises, following the purchase power parity, prices go down. This is because it now takes a smaller percentage of real income to purchase the same baskets of goods and services used in the purchase power parity. Again, following the purchase power parity, lower prices means the currency will get stronger. If the income level drops, prices will rise in proportion to income because it now takes a larger percentage of income to buy the same basket of goods. Therefore, following the purchase power parity, the currency will get weaker. If the interest rate goes up, prices will now go up because it costs more to borrow. Following the purchase power parity, the currency will get weaker. If the interest rates go down, prices will go down as it now costs less to borrow. So following the purchasing power parity, the currency will get stronger. There are two variations of the monetary model, the flexible price model and the sticky price model. The flexible price model basically states that the purchasing power parity is continuous. In other words, prices have an immediate reaction to economic changes. However, since the purchasing power parity only seems to work in longer time frames and not shorter ones, it stands to reason that the monetary model will only work in longer time frames as well. This is where the sticky model comes in. The sticky model basically states that price levels for goods and services are sticky in the short term. In other words, when the money supply, income, inflation rates, or interest rates change, price levels take a while to react on it. This slows down the effect it has on the currency and can cause the currency value to overshoot what would have happened if prices had reacted instantaneously. Like all economic theories, the monetary model has its problems when applied in real life. For instance, when interest rates are changed, the monetary model ignores the vast increases and decreases of capital flow flowing into and out of a country for investment purposes. This usually outweighs changes in price and causes a currency to appreciate from interest rate hikes and depreciate from interest rate cuts. So that's the monetary model. This now concludes the section on fundamental theories and models. I've only touched on the most common theories and only the basics of those. This is an area that traders may want to consider studying further on their own. However, by now you should have a basic understanding of what moves price in the long term. In the next section, we'll look at fundamental data, such as various economic reports, to apply to these theories. See you then.